Welcome to the Nifty Noon podcast. We're so glad you're joining us for another deep dive into the most fascinating and relevant insights from the world of crypto and beyond.
Great to be here.
Today, we're taking a look at a stack of recent updates that really shaped the past week, drawn directly from our daily newsletter. We'll be covering the rapid evolution of crypto ETFs, the growing influence of corporate Bitcoin adoption, and some major foundational moves by traditional finance players like Robinhood as they embrace the on-chain future.
Yeah, our mission, as always, is to help you cut through the noise, understand what's really important, and hopefully give you those aha moments that make you feel genuinely well-informed. We've definitely got some surprising facts and crucial context to share, trying to go beyond just the headlines.
Okay, fantastic. Let's unpack this and jump right into the latest developments that really caught our eye in the newsletter. So we're kicking things off with some truly groundbreaking developments in the ETF space, which our June 30th newsletter highlighted. For a long time, the conversation around crypto ETFs, well, it's been centered on simple spot Bitcoin and Ethereum funds, right? But now we're witnessing a significant evolution.
Absolutely. A key development we've been tracking is how this ETF landscape is rapidly expanding, pushing far beyond those single asset offerings. Our team at Nifty Noon pointed to new filings for, get this, a Solana staking ETF, and also diversified crypto index funds that seem poised to hit the market. This really marks a turning point, signaling broader institutional acceptance and, frankly, ingenuity.
That's a crucial distinction you made there. REX Shares, a pretty forward-thinking ETF provider, is barely on the verge of launching what would be the first ever Solana staking ETF in the U.S. And this is huge because it's not merely designed to track Solana's price. It actually aims to generate yield through on-chain staking and then pass that yield directly to investors.
Exactly. And this is where the nuance, I think, really matters. REX Shares has achieved this feat using a unique C-Corp business structure. This is essentially treating the ETF more like a traditional company that holds assets and engages in activities like staking, rather than like a typical investment fund.
Wow.
And the SEC seems to have accepted this innovative approach, allowing them to bypass the traditional 19b4 filing process.
Right, that's the standard regulatory application for new exchange-traded products.
Yeah, exactly. Which other crypto staking ETF hopefuls have, well, notoriously struggled with. So this isn't just some regulatory loophole. It represents a potential strategic shift in how crypto products might gain approval. It offers a clearer, maybe more complex, but clearer pathway to mainstream access for these yield-bearing assets.
So could this become like a new blueprint for other yield-generating crypto ETFs?
We think it very well might. It's definitely one to watch.
Right. And on a related note, our newsletter also reported that CraneShares, another prominent asset management firm, has filed to list a Coinbase 50 Index ETF. Now, this isn't about staking, but it's all about diversification and getting broader market exposure.
What's compelling here is how this ETF aims to track the 50 largest digital assets by market cap, based on the Coinbase 50 Index. Its holdings are reevaluated quarterly, so it provides dynamic exposure. Currently, Bitcoin, Ethereum, and XRP make up its largest allocations.
Okay.
This just signals a broadening and, frankly, maturing crypto ETF market. It offers investors more complex and diversified portfolio options beyond just holding, individual assets. It's a clear sign that more sophisticated investment vehicles are making their way into the crypto space.
So what does all of this mean for you listening? It means more sophisticated, more varied ways for traditional investors to get involved in crypto without needing to directly manage private keys or navigate complex DeFi protocols. It definitely lowers the barrier to entry significantly while expanding the types of crypto exposure available.
Yeah, that's a good point.
And as we noted in our June 30th newsletter, with the S&P 500 nearing record highs, there's a general air of optimism, which often correlates with increased risk appetite in the market. As these developments unfolded, Bitcoin was holding strong around $107,841, Ethereum was at $2,472, and Solana at $151, kind of reflecting that broader market sentiment. Now, building on this theme of traditional finance players diving deeper into crypto, the 1st of July brought a really fascinating story from Robinhood. Our Nifty Noon newsletter highlighted their massive expansion into crypto services, a move that powerfully signals the evolution of finance.
Yeah, what stands out here is Robinhood's deep and accelerating commitment to integrating blockchain technology directly with traditional finance services. They're not just adding more crypto assets to their platforms, they're actually building fundamental infrastructure to facilitate the convergence of these two worlds. It's a big step.
And this next development is particularly compelling, I think. Robinhood is launching tokenized U.S. stocks and ETFs for its European customers, initially leveraging the charterTrump network. But the really significant revelation, the big news, is their development of their own Layer 2 blockchain, which they're calling the Robinhood chain.
Wow.
This proprietary network will eventually facilitate these tokenized real-world assets, bringing securities directly onto the blockchain.
Okay, that raises a critical question for the industry, doesn't it? What does it truly mean for a mainstream brokerage like Robinhood to build its own blockchain? It signifies a massive strategic push to become an all-in-one hub for digital assets, truly blurring the lines between what we call TradFi traditional finance and crypto. It's a huge investment in the future of finance itself.
Mm-hmm.
And our newsletter also highlighted that they're rolling out perpetual futures with up to 3x leverage in the EU, and perhaps even more impactful for U.S. customers, introducing crypto staking for Ethereum and Solana to eligible users.
Right, and we had already seen Robinhood launching new crypto futures just the day before, on June 30th. Now, with staking for U.S. customers and this grand plan for their own chain, this feels like a much bigger, much more strategic play.
Definitely.
This aggressive expansion, including things like crypto credit card rewards and AI-powered insights, could be a powerful catalyst for bringing truly mainstream users into the crypto ecosystem. They're not just dipping a toe in, they're really diving in head first.
Absolutely. And if we connect this to the bigger picture, it suggests a profoundly bullish long-term outlook from a major player on the industry's foundational role in global finance. And Robinhood isn't alone in this. We also noted other significant developments in our newsletter, like BitMine raising $250 million to start stacking ETH, a major investment in Ethereum infrastructure.
Wow.
And Spain's Venati Coffee getting approval to acquire up to $1 billion in Bitcoin for its treasury strategy. These are strong indicators of broader institutional and corporate interest validating the asset class.
Yeah, that's significant.
As for the market context on July 1st, Bitcoin was around $106,653, ETH at $2,442, and Solana at $148. So a stable, maybe slightly fluctuating backdrop to these big corporate moves.
Okay, let's shift our focus now to July 2nd's big topic from Nifty Noon, a new wave of corporate Bitcoin accumulation and what it might truly mean for market stability.
Right, this is a crucial development that I think demands closer examination. Our newsletter revealed that public companies are now accumulating Bitcoin at a faster pace than even the ETFs for the third consecutive quarter.
Third quarter, wow.
Yeah. In Q2 alone, public companies added roughly 131,000 BTC to their balance sheets. That's an 18% increase. Compare that to ETFs, which added about 111,000 BTC, an 8% increase. The numbers really speak volumes.
So public companies outbought ETFs by 20,000 Bitcoin in just one quarter. That's an incredibly strong signal of Bitcoin's growing acceptance as a treasury reserve asset. It indicates a fundamental shift in how corporations view digital assets. But as our newsletter warns, there might be a significant catch here, a new layer of risk we need to understand.
Indeed, and a crucial one. The question isn't just about the amount of Bitcoin being accumulated, but who is accumulating it, and maybe more importantly, how they are financing these acquisitions. We're seeing analysts raise concerns that many of the newer companies adopting this model are far more highly leveraged.
Okay.
Unlike, say, a company like Strategy, formerly MicroStrategy, which has been battle-tested through multiple major market downturns and financed its Bitcoin mostly through equity and convertible notes, well, these newer firms haven't faced that kind of test yet.
Right.
Reports highlighted in our newsletter warn of a potential death spiral scenario.
A death spiral. That sounds pretty serious. What does that actually mean for you, our listener, who might be watching institutional adoption as a sign of stability?
It's definitely a scenario to be aware of. It suggests that a significant rapid drop in Bitcoin's price could trigger margin calls for these highly leveraged firms.
Okay, margin calls.
Yeah, a margin call, for those unfamiliar, is basically a demand from a broker for an investor to deposit more money or securities to cover potential losses on their leveraged position. If these firms can't meet those calls, they'd be forced to sell their Bitcoin holdings to cover the debt.
Which pushes the price down further.
Exactly. Which could then create further downward pressure on the price, leading to more margin calls and, so on. It's a potential cascading effect. So this represents a unique phase of institutional interest, but definitely with a new, potentially amplified layer of systemic risk.
Got it.
And it's worth noting, our newsletter also mentioned the SEC's CorpFin division issuing fresh guidance on disclosure expectations for crypto ETPs. So regulators are certainly watching this trend closely and are keen on transparency around these new risks.
Makes sense.
We even saw a small example of market volatility playing out in our project news from that day, with a developer, James Wynn, getting partially liquidated for about 4.59 BTC. Just a stark reminder of the market's sometimes unforgiving nature.
Yeah, absolutely. And for July 2nd, Bitcoin was around $107,726, Ethereum at $2,449, and Solana $149, kind of holding steady amidst these complex dynamics.
Hmm.
Okay, bringing us to July 3rd and back to those fascinating ETFs. We noted in our Nifty Noon newsletter that the next chapter in the crypto ETF story officially began with the first US-based Solana ETF starting to trade.
That's right. The REX Osprey Solana plus staking ETF, trading under the ticker SSK, officially went live. This product offers traditional investors exposure not just to SL's price movements, but also its staking rewards, which, as we said, is a true first for the U.S. market.
Right.
The innovative structure, designed to pass staking yields directly to investors, uses Anchorage Digital as the custodian and, importantly, is regulated under the Investment Company Act of 1940. That's a cornerstone of U.S. investment law. So this is a really significant bridge between traditional asset management and crypto-native yield generation.
What's truly striking here, though, is that while the launch is undoubtedly a major milestone, the market's initial reaction was, well, a classic buy the rumor, sell the news event. Yeah. Our newsletter noted that in the lead-up, SOL's price had popped to $161, probably fueled by anticipation. However, the excitement was pretty short-lived. The price quickly fell back toward the mid-140 years immediately after the ETF went live. It really makes you wonder about the market's short-term psychology versus, long-term fundamentals.
Yeah, it does. And it raises an important question for you to consider. Why the immediate price drop despite such an innovative and institutionally backed product? Often, the market prices in anticipated good news well before it actually happens. Then, once the event occurs, traders who bought purely on speculation tend to take their profits, leading to that temporary pullback. The price is now consolidating, apparently, with technical analysts in our newsletter pointing to key levels of resistance around $159 and support near $140. So while the initial ETF hype appears to have, fizzled a bit, the long-term impact of sustained institutional access to Solana and its staking yield definitely remains to be seen.
Right.
The true test will be consistent inflows over weeks and months, not just the launch day fanfare.
Absolutely. And we also saw some other significant news on July 3rd that could really impact future market movements dramatically. Consider Ripple applying for a national bank charter from the OCC. That's the Office of the Comptroller of the Currency, which supervises national banks.
Right.
And also a FedMaster account. This isn't just ticking a regulatory box. It means direct access to the Federal Reserve's payment systems. It fundamentally signals Ripple's ambition to become a core infrastructure provider within traditional banking itself, bridging those two worlds.
That's a huge move. Potentially game-changing if they get it.
Exactly. Meanwhile, our newsletter highlighted that BlackRock's Bitcoin ETF is already generating more revenue than its S&P 500 fund.
Wow, really? More than the S&P 500 fund?
Yeah. That's a staggering metric, isn't it? It shows just how quickly institutional demand for Bitcoin is ramping up.
No kidding. That's impressive.
And on July 3rd, Bitcoin stood strong around $109,344, Ethereum at $2,592, and Solana was at $153, indicating a pretty resilient market despite the launch day jitters for that new ETF.
Yeah, holding up well.
Okay, before we wrap up, let's take a quick look at the NFT market activity, which also saw some interesting trends throughout the week as we covered in our newsletter.
Sure. What we observed was CryptoPunks consistently at the very top of sales, really solidifying their blue chip status in the NFT space. We saw significant trades like hashtag 8675 for 46.95 ETH, hashtag 5213 for 50 ETH, and hashtag 6035 for 45 ETH.
Wow, big numbers.
Yeah, these aren't just high prices. They reflect a consistent demand for historically significant foundational digital art. It really speaks to the enduring value ascribed to these early projects.
That consistent performance from CryptoPunks is a bit of a contrast to other parts of the market sometimes, isn't it?
Yeah.
What were some of the other movers?
It is, yeah. On the winner side, we frequently saw projects like NodeMonks and Ordinal MaxiBiz experiencing pretty significant gains. NodeMonks, being one of the first major PFP projects on Bitcoin Ordinals, has been riding that renewed interest in the Bitcoin ecosystem, while Ordinal MaxiBiz often benefits from its unique generative art and strong community. Conversely, projects like Bored Ape Yacht Club and Tensorians sometimes experience declines, reflecting the shifting narratives and selective market attention. The Bored Ape market, for example, often reflects broader sentiment and liquidity, and while it's still a dominant force, it's certainly not immune to profit-taking or shifts towards newer collections. This ongoing dynamism, with established giants facing new challengers and constantly shifting narratives, truly shows the evolving maturity and sometimes volatile nature of the NFT landscape.
Yeah.
It's a constant dance between historical significance, perceived utility, and, let's be honest, speculative interest.
Absolutely. Well, what a week of insights. We've seen the crypto market continue its rapid evolution, with groundbreaking ETFs offering staking yields and diversified portfolios, major traditional finance players like Robinhood building their own on-chain future, and corporations diving deep into Bitcoin, bringing both immense opportunity and, as we discussed, new layers of risk.
Yeah, it's abundantly clear that the lines between traditional finance and crypto are blurring faster than ever. It's creating both exciting innovations and complex challenges that definitely require a discerning eye.
So what does this all mean for you, and what's maybe a provocative thought to leave you with? As crypto continues its mainstream integration, how might that traditional buy the rumor, sell the news dynamic, which we saw play out so clearly with the Solana ETF, how might that shift or evolve when institutional and corporate players become dominant forces?
Interesting question.
Will their longer-term investment horizons eventually smooth out this short-term market psychology, or could their sheer size actually amplify it? It's a fascinating question for the future, I think.
Definitely something to ponder.
Well, thank you so much for joining us for this deep dive. We really hope you found these insights as valuable as we did extracting them from our newsletter this week.
Yeah, thanks for tuning in.
If you want to keep up with all these fast-moving developments and get these daily crypto updates, make sure to subscribe to the Nifty Noon newsletter on Substack and follow Nifty Noon on X. We'll be back soon with another deep dive.